All right, it's 2026. Let's say you've got some cash set aside. You know you want to keep it safe, but you also want it to do a little more than just sit there. So, where's the best place to park it? Today, we're diving into two of the absolute safest options out there: good old-fashioned bank CDs and U.S. Treasuries.
But first, let me ask you this, and be honest. Take a look at your regular savings account. Is it really doing anything for you? Because with the rates we're seeing right now, just letting your cash sit in a standard savings account probably means you're leaving free money on the table.
So that's our mission today. We're going to find the absolute best and safest home for your cash. We'll look at the options, we'll put them head-to-head, and by the end of this, you'll have a super clear idea of what to do next.
First up, we've got the one you probably heard of a million times, the Certificate of Deposit, or the CD. It's a classic for a reason. The deal is simple, right? You agree to park your money with a bank for a specific amount of time, and in return, they give you a guaranteed fixed interest rate. It's steady, it's reliable, it's predictable.
So what kind of rates are we actually talking about? Well, let's look at some real numbers from January 2026. If you look at some of the top online banks, think places like Capital One or Synchrony, you're seeing rates anywhere from 3.5% to 4% for terms around 6 to 12 months. That's a solid guaranteed return you can lock in. Not bad at all.
Okay, but like with anything, there are a few rules of the road. The really good news? A lot of online banks don't even have a minimum deposit anymore. And your money is incredibly safe. FDIC-insured up to $250,000. Now here's the catch. If you need your money before the term is up, you'll pay a penalty, usually giving back a few months of interest. And, this is important, don't forget that all the interest you earn is fully taxable.
All right, let's pivot to our second contender, U.S. Treasuries. Now this is a little different. Think of this as lending your money directly to Uncle Sam. And because your loan is backed by the full faith and credit of the U.S. government, they are considered, and this is not an exaggeration, one of the safest investments on the entire planet.
Now, Treasuries isn't just one thing. It's kind of like a family of investments. You've got your short-term T-bills, which mature in a year or less and are yielding around 3.6% right now. Then you've got the longer-term T-notes, which can go from 2 to 10 years and usually offer a little higher rate. And then there's the really interesting one, I-bonds, the inflation fighters, which are currently paying over 4% specifically to help your money keep its purchasing power.
I-bonds are pretty special, and their interest rate is why. It's actually a two-part deal. First, there's a fixed rate. Right now, it's 0.90%, and that part never changes for the entire life of the bond. Then you add a second rate, a variable one, that actually resets every 6 months to keep up with inflation. It's a really powerful combo.
So, the rules for Treasuries. Well, you can get started with as little as $100, and like we said, they're about as safe as it gets. But here it is, the secret weapon, the thing you really need to hear. The interest you earn is exempt from state and local taxes. And that, well, that can be a very big deal.
All right, introductions are over. It is time for the main event. Let's put CDs and Treasuries side by side in a head-to-head battle and see which one comes out on top for your money.
Round 1. Safety. You know what? This one's an easy call. Both are incredibly secure. CDs have that rock-solid FDIC insurance. Treasuries are backed directly by the U.S. government. For all practical purposes, your money is as safe as it can possibly be in either one. Let's call this round a tie.
But what if you need to get your hands on that cash early? With a CD, it's pretty straightforward. You know you're going to pay that interest penalty. With Treasuries, it's a little more nuanced. Things like T-bills can be sold, but their price might have gone up or down. I-bonds are a different story. They are locked up tight for 1 year, no exceptions, and have a small penalty if you cash out before 5 years.
Okay, now for the big one, the real game changer. Let's talk taxes. This is where Treasuries can really pull ahead. See, the interest from a CD gets taxed on every level: federal, state, and local. But with Treasuries, you only pay federal income tax. Let's make this real simple. Imagine you earn $1,000 in interest. If you live somewhere like California or New York, you might owe $80 or more in state taxes on that CD interest. With a Treasury, that $80 stays right in your pocket. That can make a huge difference in your actual take-home return.
All right, so we've got all this info swirling around. We get the differences, but what do you actually do with it? Let's get practical and turn all this talk into a real, actionable playbook for 2026.
Let's start with CDs, because honestly, this is about as easy as it gets. You can open an account at an online bank in just a few minutes. Pick your term, say 1 year, and just transfer the money over. Now here's the #1 pro tip. Set a reminder in your phone's calendar for when it's about to mature. Seriously. That way you can decide what to do next instead of letting the bank just roll it over automatically, maybe at a lower rate. Now, buying treasuries might sound a little intimidating, right? Buying something from the government, but it's really not. You've basically got two easy paths. You can go straight to the source, the government's own website, TreasuryDirect.gov, or, even easier sometimes, you can just buy them through any major brokerage account, just like you'd buy a stock.
So why are we even having this conversation right now in early 2026? It's all about timing. The general feeling is that interest rates have peaked and are now starting to drift down. That means the chance to lock in these really attractive guaranteed rates for a year or two might not be around forever. It makes acting now a pretty smart move.
So, to get you started, here are 3 simple strategies to think about. You could build what's called a ladder. You just split your money into a few different CDs or T-bills with different end dates. That way, you always have some cash becoming available. Or, if you're thinking longer term, using those I-bonds as a hedge against inflation is just a fantastic tax-friendly strategy.
And that all brings us to the final question, and this one is really for you. Knowing that these great rates might be hitting lower, what's your priority? Is it to lock in one of these excellent guaranteed returns right now while you still can? Or is your priority to stay flexible, to keep your cash ready for whatever comes next? There is no wrong answer, but deciding that for yourself, well, that's your next